Hi, I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast. We get to know the people behind the portfolios, hear from our portfolio managers and analysts, some of the lessons they've learned in their career, their investment edge, a few ideas, and a little bit about Capital Group as well. Today we have Shannon Ward with us, a fixed income portfolio manager based in Los Angeles. Today's episode, it's all about mindset and markets. Shannon shares how she brings her psychology degree to her portfolio and also the evolution of the high yield market. Shannon, welcome to the podcast.
Thank you for having me.
Lots of Capital Group folks come from different areas in life, and one of yours was psychology.
Yeah.
Not a lot of our folks have studied psychology.
Right.
So tell us a little bit about why you studied psychology. I'll get into how it may impact you as an investor, but how'd you go from psychology to managing high yield portfolios?
I studied psychology without knowing what that was going to mean for me as a career. I just did it because I thought it was interesting. So I spent 4 years after graduating trying to find the career that would use psychology, and it wasn't obvious. So I went back to business school. And in business school, there was an entrepreneurial finance class that I loved and was taught by a really great professor. And he was really a sort of believer that cash flow lending was the thing that really helped entrepreneurial companies grow. And he used to say things like, cash flow is more important than your mother. And
Wow, well, that's super important. He must not have liked his mom very much.
I know, right? So that class was really interesting. I got a job out of business school in banking. And it was banking the old way, basically lending money to companies, not investment banking. And that was really the way I thought, well, there's a lot of psychology in entrepreneurial lending and lending to small companies. You know, what separates a good company from a bad one? What makes a management team better than another? You know, how do they figure out how to adapt to the markets? It was a lot of psychology. And so I stopped trying to turn myself into a finance person and ignore the psychology background. And I started to incorporate it and figure out how that would make me a better investor.
And that makes sense from a lending perspective in the traditional lending model. How does that work when it gets to high yield lending? Because you're lending, you're still in the lending business.
Yep, 30-some years on.
You're still lending people
Yep.
money, companies money. How does that psychology work in your day-to-day investor job today?
Yeah, right. It's so applicable.
Right.
Because especially in high yield, where all the good companies are basically the same, they all pay you the coupon and the money back at maturity or refinanced before. And it's really the bad companies that you have to look out for. And so the psychology around what makes this company a good one and identifying the ones that aren't good is the whole important point, really, to high yield investing.
It's interesting. As an investor, you're pretty rules-based and you're focused on more of a diversified than heavily concentrated portfolio. Talk to us a little bit about high yield investing and how that matters.
Yeah, it goes a little bit back to sort of the early learnings about good businesses and those that aren't. And in high yield, it's really important because the whole promise of high yield is the coupon that you're going to earn. And so if you are able to avoid the things that don't pay you the coupon, you're way ahead and you get the chance of earning the high yield that's promised. So it is all about avoiding things that don't work out. And if I think my history of investing in high yield companies tells me that if you can avoid ever being in the bottom decile because something has really gone wrong, you have a much better chance of consistently being in the top quartile. And so it's super important in high yield investing because of that asymmetry of returns. All the good companies pay you the coupon. The bad companies, you can really suffer losses.
And so in that rules-based formula in your own mind, one of them is be diversified.
Be diversified. There's no benefit for not being diversified.
And is there a maximum size of a holding that you would have in your portfolio?
Try not to be more than a 2% position.
Okay.
And only a 2% position if it's also a liquid big issuer in the market. So a 2% position in a company that isn't very big is too much. That's a lot. If it's a 2% position in a company that's big and liquid where you can change your mind and be nimble, that's acceptable. So 2% is one of those sort of hard limits that I have.
And how do you work with the analyst? I know it's super important to you, and you're an analyst of the analysts. So how do you work with them?
Yeah, I grew up being an analyst, so I appreciate what that job is, how hard it is, how important it is. And the analysts are amazing. They do a really, really good job. So the only thing that I can do is help on portfolio construction. So that's where the rules-based, the diversification, they're coming up with all the great ideas.
They'll do the credit expertise,
Yep.
knowing the company backwards and forwards.
Yep.
And
I
you'll
then
think about
put it together into a recipe. They're giving me the ingredients. I build the meal with the recipe ingredients. So it's really my job. Because I used to be an analyst, that transition from being an analyst to being a portfolio manager is not easy because you're so used to knowing everything about the company. And you have to go from being a mile deep and an inch wide to the exact opposite, a mile wide and an inch deep. And you have to do that realizing that the analyst knows better than you about the company, but your expertise is now putting it all together and making it work.
That's a hard transition. I mean, the way in which you describe it, you go from knowing everything about a company and being the expert to then being someone who's really focused on risk management and portfolio construction and letting the analysts run.
Yep.
And for you, when you were an analyst, how did you think about diversification? Did you have the same mindset then, or is it different in that perspective because you're just trying to express your highest conviction?
It is different because you're trying to express your highest conviction, but it's a personality thing too. And maybe this is me always thinking about the psychology of behavior and of people. I think people are just built a certain way. And so as an analyst, I still had that desire for diversification. I wanted my best ideas to be put forth and to make it into the portfolio. But I also had that mindset towards risk control and risk management. I think it's just part of my personality.
Well, it also helped our overall high yield strategy when we hired you, in that you're a core high yield portfolio manager who is diversified. We have other folks whose strengths are super deep credit.
Yeah.
And putting those blend together in the capital system where everyone expresses their own highest conviction, it ends up creating a holistic portfolio that works.
Yes.
For you, what we needed was just to make sure that you didn't have style drift, that the style that you've always managed in, that you continued in, which you have, and that's what made everything work.
Yeah.
So thank you.
Yes, you're welcome.
We're glad you did that. Something you and I have talked about is how you avoid things that you don't understand.
Yeah.
Which is a good policy in general.
Yes.
But how does that work in a high yield portfolio? What kinds of things don't you understand that you would just say, part of my rules-based system, I'm just not going there?
Yeah. I mean, it's so easy to say, I don't get it, I'm going to pass, because we have other investors that are doing different things. So the portfolio can still benefit from something that I don't like or understand. Someone else, if it's a good company, will figure it out. So I don't have to worry about it if I don't get it. And also, it's really, when things don't go right, if you don't really understand what's gone wrong, it's really hard to deal with it. Like, do you follow on with more money? Do you buy more at a lower price? Do you sell? If you don't understand what got the company there, it's really hard to make those difficult decisions. So, and there's, over 1,000 issuers in the high yield market.
You can be picky.
I don't need to own everything. I can, even with my sort of desire for diversification, I can find 200 good companies. I don't have to buy the one I don't understand or want to think about.
No, that makes sense. And what folks have said on this podcast before, whether they're stock or bond investors, is it also can take up a lot of mind share.
Yeah.
Getting stuck in something that you don't necessarily understand very well and trying to work yourself out of what to do now takes up a lot of emotional energy that can be better spent elsewhere.
Yeah, it's not only harmful for the portfolios, it's also really hard just personally to deal with.
And at a point in time today, high yield is not quote unquote cheap. It spreads, credit spreads. So the amount you're getting paid above the risk-free rate to own a high yield credit, those spreads are relatively low based on their history.
Yeah.
How do you think of valuation today?
Yeah.
And where do you see opportunities for folks to be invested?
Yeah. Most markets are efficient. Maybe not immediately and in a short period of time, but over the span of time, markets are efficient. And so spreads where they are today is, I think, appropriate for the risks underlying the high yield market. So that's why spreads are where they are. The quality of the companies is better than it's been. There's no big sector dominating the market, which could be a cause for concern. There's no maturities coming up, no big maturity wall. So spreads, I think, are representative of the risks that are apparent that exist in the high yield market.
And defaults, low single digit default rates.
For the last decade, they've been, 2 to 2.5% per year. So it's really, I think spreads are tight for a reason, but that's still a good place to earn yield. We're still talking about good quality companies paying you, 7% range. So for a lot of investors, that's all they need. If you could tell an investor, I'm going to give you 7% return annually, a lot of investors would say, fantastic, thank you very much, I'm done.
Yeah, one of our former guests was one of your colleagues in the high yield market, David Daigle, and he talks about owning, not trading high yield.
Yeah.
Over the full cycle, and just having that be that high yielding portion of your bond portion of your portfolio.
Yep, exactly.
I want to show you something I found in your office, and I have to move this closer to me because I have to use my core.
It's a bit heavy.
And my core is not as strong as I would like it to be. Okay, good. So I have in front of me, and I'll ask you to describe it for our listeners, but it is a heavy, small propeller.
Yeah.
What am I holding, and why is it so heavy?
Well, it's heavy because it's solid brass, so it's very
okay, that's
heavy.
That's a good reason.
Yeah. And it is essentially a model of a much larger propeller. So my dad was a mechanical engineer, and he did a lot of expert testimony on boating accidents. That was his sort of side hustle.
His side hustle.
Yeah. One of the cases that he was working on involved a very large vessel that crashed. And so his job was to say whether what the people said happened physically from a wave dynamics perspective actually could have happened. So he built a model of the big vessel and, put it in a wave tunnel and figured out, what really could have happened.
And had explained that.
Exactly. Had explained whether or not the scenario that was laid out was physically possible. So that's the remnant from that part of his life. And he had it in his office. And when he died, I grabbed it and said, I want this in my office. So it's been in my office for 30 years.
Makes you think about him.
Yeah, it makes me think about him. I get a little emotional.
No, that's good. It's good. One of the reasons we do the office treasure hunt is it's important to you. It's part of who you are.
Yeah, it's also beautiful. It has heft. It's beautiful. So it's a really great treasure.
A bullet journal.
Yeah.
And I remember this from our interview process nearly, as you say, a decade ago. But talk to us about what a bullet journal is and how you use it.
Yeah. So a bullet journal is a specific type of journal, which is not just writing down your thoughts and your aspirations, but what you actionably want to do. So it's the things that I need to accomplish now. So a traditional to-do list. It's the things that I can't accomplish today, but I want to get done in the near term. So there's sort of a bit of a plan. And then it's a lot of things about what do you really want you to spend your life's time on? Like, let's be thoughtful about how we spend our time. And so a bullet journal gets all of that stuff together into one. It's what I use it for mostly is the traditional to-do list type of stuff. But there's also pages in there about things I want to do this year. There's personal stuff in there about things I want to accomplish. So it's really a place for me to write everything down, keep me accountable, and not forget. So it's a great way to manage time and keep the focus.
Well, in some ways, it's an accountability journal.
Yes, it is. Yep.
Just holding yourself accountable. And can you apply that same journal if you just used it for your portfolio? It could have in there watch names of some credits that you're not necessarily sure about, ones that if it got a lot cheaper, you'd be interested in. I mean, is that same
exactly
mindset
it's lessons
apply?
Learned are in there. Things that I've observed other people doing that I want to incorporate into my process. So it's all sorts of, things that occur to me that I think could make me a better investor that I've seen, and then, write it down.
So what are some lessons you've learned? You've been doing this, as you said, since the early 90s, so call it 30 years.
Yeah.
What are high yield lessons learned for you?
Yeah, and that's a lot of different cycles, right? You think about
Sure is.
30 years, a bunch of things have happened. Not all of them look the same, right? They all look a sort of different. And that's one of the lessons learned. The markets move based on, we don't know exactly what. There will be a correction. It always happens. So it's just a matter of how do you position for it in the moment? How are you prepared for it before it happens? And what you do that you've learned along the way that's been helpful to get through it. And one of the biggest lessons learned for me is around market behavior and how it swings to extreme levels. And so you have to be skeptical all the time because markets will do that. They'll move in extreme ways. So learning lessons from prior crises is for me around being skeptical, building the portfolios for some safety, and knowing that being comfortable when the cycle does happen, that you are built for it. So you don't freak out in the moment because you've built the portfolio for something like that happening.
So it
that's
gives you
one
some
huge
confidence to be a bit contrarian.
Yeah,
Like the global financial crisis, when it looked like everything would default.
that's right. Yep.
You can remember that cycle and say,
Find the good companies that have been really, sort of washed out for no reason because people had to sell to raise cash or because they were part of a sector that people didn't like, but this is a good company within a sector that people don't like. So being able to see those things and have the portfolio with enough cushion that you can then take advantage of it, and that's been a huge lesson.
So every cycle may be a bit different, but they may rhyme.
Exactly. And people's behavior, it's really about behavior. It goes back to sort of understanding markets and behavioral finance. People just behave in irrational ways. And so being able to observe that and then sort of take it to your benefit.
And on the other side of lessons learned is your unique investment edge. We already talked about you being more diversified, more of a core manager, but what do you think's your specific investment edge as a high yield manager?
Yeah, it definitely is taking what the analyst tells me, what the markets are saying in terms of how they're behaving, and building it into a portfolio that can withstand whatever happens. That is definitely the edge. Combining those three things, the analyst, the market, and the portfolio that will build it for the long run.
Yeah, it's interesting. Portfolio construction is such an intentional thing.
Yes.
It's not a compilation of different ideas. It's a broader risk management framework.
Yep.
And it creates some resilience in that portfolio.
And you have to look at it every day.
Yeah.
You have to look at it every day. And most of the time that I spend with the analysts are around, what do I own that is a problem we don't know about yet? Let's figure out what that thing is that we don't know yet is going to be a problem. And we're not getting paid for it, and weed it out. So the high yield investing is a lot about weeding out.
And who mentored you earlier in your career? Maybe they're still doing it today, but who mentored you earlier in your career that had an impression on you or made you part of the investor you are today?
Yeah, it goes back to my dad. He was a great mentor for me. He started his career, he was as I said, mechanical engineer. He started his career at Cape Canaveral in Florida when the space program was early days of the Mercury program, when the rockets were blowing up on the launch pad, literally. There was so much trial and error. And, occasionally they would get up a little bit off the pad and then explode. Sometimes they would make it a bit further off the pad, veer off course, and then they had to explode them for fear that they would land on a nearby beach. So it was a lot of trial and error back in the early part of his career. And he was always like, let's go back to the drawing board. Let's figure out what we can do to make this work better. And a lifelong learner. He was just always curious about learning new things. And I think he instilled that in his two daughters to just try stuff. If his famous tagline that we always say as a family is, if you don't try, you've already failed. And so just trying things is really what he said. He would always answer the phone, Ward speaking, how may I help you? It was just his mentality
Right.
about helping people.
That's great. So our previous guest on the podcast, Kelly Murphy, also, by the way, has a husband with the same name as your husband. And,
it's a good name.
And lived in London in the US. You spend quite a bit of time in London. So I'm going to ask you some personal things about London because I did this with Kelly. I was
okay,
check out the answers. London, and how many years were you in London?
5 years.
5 years in London. Kelly's been there 13. So, okay, well, we're going to have to see what happens. Better food, US or UK?
Other than Mexican food, which California has an absolute, no question, better array, I think the food's better in London.
Okay, she said the same thing. Better sports?
I mean, if you're a soccer fan, for sure, London. But there are so many other sports here, college football. So I think the US has it on sports.
Better commute into work?
Okay, so my commute in London took 10 minutes and it was a walk.
Okay, so that was better.
So it's impossible to have a stressful commute to work if you're walking. So yeah, for sure, London.
Better weather. I'll finish on an easy one.
Come on, Mike.
I'll finish on an easy one. All right, we're gonna end with a moment of gratitude, and I'm gonna share with you the mug, and on the back it says "Be obsessively grateful."
I love it.
So I'm grateful for you joining, and not just joining today, but joining Capital Group nearly a decade ago. You've had such an impact on Capital Group, on our fixed income group, on high yield clients and the high yield team. So we're grateful you joined us.
Thank
but what
you.
are you grateful for?
Well, I mean, part of it is grateful that recruiter called me 10 years ago to tell me about this job. So grateful for the person or people who gave that recruiter my name. And then just grateful that I get to do this job every day. Like, this is an amazing job. It's so interesting. No day is the same. I get to surround myself with incredible investors who are there to help me get better, who are willing to answer my questions, and just to be a part of this firm that has this great culture. I'm so grateful for it.
Excellent. All right, Shannon, we will leave it there. Thank you all for joining us. I hope you join us next time and have a great day.